For years, investors were told that the smartest thing you could do was remove emotion, remove prediction, and simply let the system work. Buy the market, stay consistent, let compounding handle the rest. And for a long time, that advice looked almost perfect. Portfolios grew, fees dropped, and millions of professionals quietly funneled their savings into the same strategy every month without thinking twice. But when a financial strategy becomes so successful that nearly everyone begins using it the same way, something unusual starts happening beneath the surface. The system itself begins to change. And the uncomfortable question is whether the safety people believe they're buying is actually creating a new kind of risk that almost nobody is paying attention to. Index funds are still one of the most effective financial tools ever created. For most people, they remain one of the simplest and most reliable ways to participate in long-term economic growth. Low costs, automatic diversification, and the quiet force of compounding have helped millions of ordinary professionals convert years of labor into long-term capital. For decades, the logic has been straightforward. Instead of trying to outsmart the market, you simply own the market. You remove ego from the equation, keep costs low, and allow time to do the heavy lifting. In a world filled with financial noise, this approach feels stable, rational, even safe. If someone asks for a single system that quietly turns income into long-term wealth, indexing would likely sit near the top of that list. But stability can sometimes hide a small crack. And the crack often appears not in the tool itself, but in how widely that tool gets adopted. Because when a strategy works extremely well for a long time, people naturally converge around it. Over time, the strategy stops being one option among many and slowly becomes the default. This is exactly what has happened with passive investing. Trillions of dollars now move into index funds through retirement plans, automated portfolios, and long-term savings programs. Every month, paychecks are converted into investments through systems designed to be frictionless. The process is efficient, predictable, almost mechanical. At first glance, this seems like pure progress. More people investing, lower fees, better long-term outcomes. But there's a subtle question that almost no one stops to ask. What happens when too many participants begin investing in the exact same way? When the flow of capital becomes synchronized across millions of portfolios, something deeper begins to shift. Not dramatically, not immediately, but slowly, almost invisibly, the structure of the market begins to change. For most of modern financial history, stock prices were heavily influenced by active decisions. Analysts studied balance sheets, debated valuations, and allocated capital based on judgments about profit margins, competitive advantages, and long-term growth. Markets were messy, inefficient, and full of disagreement. That disagreement was actually part of the system. It created a constant process of price discovery. Some investors were optimistic, others cautious. Capital flowed toward companies that looked strong and away from companies that looked weak. Passive investing operates differently. An index fund does not examine a company's strategy or analyze its leadership. It follows a rule. If a company occupies a certain weight inside an index, the fund allocates capital accordingly. The process is not emotional. It is not judgment-based. It is simply mechanical deployment of capital across a predefined structure. At small scale, this doesn't change much, but at massive scale, it quietly alters how money moves through the system. Large companies that already dominate an index receive a larger share of every new dollar entering passive funds. Smaller companies, even if they are profitable and innovative, receive less attention simply because they occupy a smaller space inside the index framework. This is where the first psychological shift happens for many investors. They begin to realize the market is not driven solely by business fundamentals anymore. It is also shaped by capital flows. Money does not just chase profits, it also follows structure. And the structure of major indexes tends to reward size. Over time, this can lead to concentration. When a handful of companies grow extremely large, their weight inside the index expands. As that weight expands, they absorb an even larger share of new investment flows. On paper, an index fund may contain hundreds of companies, but in practice, a large portion of performance may come from a relatively small group at the top. The portfolio looks diversified, yet economically, it may rely heavily on a narrow segment of the market. For many investors, this realization creates a quiet contradiction. The original appeal of index investing was diversification, the idea that owning the market spreads risk across many businesses and sectors. Yet, the very mechanism that makes indexing efficient can slowly concentrate exposure toward the largest players in the system. None of this means the strategy is broken, but it does reveal a deeper layer beneath the surface. Financial systems are not static. They evolve based on incentives, behavior, and scale. When a strategy becomes dominant, its side effects become part of the environment. Another layer appears during periods of stress. Passive investing functions smoothly when capital flows steadily into markets. The process of buying becomes routine. But markets are not only driven by optimism. Periodically, fear enters a system. Economic uncertainty rises. Investors become cautious about risk. During those moments, redemption flows begin to accelerate. Investors sell fund shares, and those funds must meet withdrawals by selling underlying assets. Because many portfolios are built around similar indexes, the selling pressure often concentrates in the same large companies that previously received the most inflows. This does not guarantee collapse, but it can create synchronized movements where prices adjust rapidly as liquidity shifts. What makes this dynamic interesting is that it's not primarily a valuation problem, it's a flow problem. Capital enters the system together, and during moments of stress, it can attempt to exit together. Markets eventually stabilize, but the path between those points can become volatile. Yet the most underestimated risk in this entire structure is not mechanical, it is psychological. Index funds are often marketed as the ultimate long-term solution. Buy regularly, hold patiently, and allow compounding to do the work. And for disciplined investors, this philosophy can be incredibly powerful. But human behavior rarely operates in clean theoretical models. When markets fall sharply, the emotional experience feels different from the intellectual plan. Portfolios decline, headlines intensify, the psychological baseline shifts. Investors who believe they were long-term thinkers suddenly feel the pressure of uncertainty. Some begin selling not because a strategy failed, but because fear overrides patience. In that moment, the real gap appears. Not the gap between active and passive investing, but the gap between financial strategy and human behavior. This is why the real framework for thinking about passive investing is not simply about diversification or fees. It is about structural balance. A useful way to think about this is what we might call the stability triangle. Every long-term portfolio sits at the intersection of three forces: concentration risk, liquidity pressure, and behavioral tolerance. Concentration risk measures how dependent your portfolio is on a narrow group of assets or sectors. Liquidity pressure measures how exposed your capital is to forced selling during volatile periods. Behavioral tolerance measures how comfortable you remain when markets move sharply against you. If any one of these points becomes unstable, the entire structure weakens. Many investors focus almost entirely on expected return, ignoring the other dimensions. But long-term wealth is rarely destroyed by average returns. It is destroyed by structural fragility and emotional reaction. Understanding this changes the conversation. The goal is not to abandon passive investing, it is to design a financial system that protects optionality. Optionality means having choices when conditions change. It means your portfolio can absorb volatility without forcing decisions at the worst possible moment. In practical terms, this often involves broader diversification across global markets, exposure to different types of assets, and maintaining liquidity buffers that protect autonomy during downturns. Not because markets are destined to collapse, but because resilient systems assume uncertainty rather than denying it. Looking forward, the future of passive investing will likely involve continued growth. Automation, retirement systems, and global capital flows all support its expansion. But as the strategy becomes larger, its influence on market structure will continue evolving. Concentration cycles may intensify. Liquidity events may appear more synchronized. None of this invalidates the philosophy of low-cost investing. It simply means the environment surrounding it is becoming more complex. And complexity is where thoughtful investors create advantage, not by predicting every market movement, but by understanding the forces shaping long-term trajectories. This is really what Nick Finance is about. Not chasing headlines or selling quick financial fixes, but building the mental frameworks that allow you to think clearly about money over decades rather than months. Most people watching this channel are professionals, operators, people converting their time, skill, and effort into income every day. You're doing many of the right things already. You work, you save, you invest. But somewhere along the way, there is often a quiet feeling that the system is harder than it should be. That despite doing everything correctly, financial freedom still feels slightly out of reach. Part of that tension comes from misunderstanding what wealth actually is. Wealth isn't just the number inside an account, it's the degree of autonomy your capital creates. It's the margin between what you earn and what you need. It's the optionality to make decisions without being cornered by financial pressure. Index funds can absolutely be part of that system. They are powerful tools for compounding capital over long periods. But tools only work well when they are placed inside thoughtful structures, when you understand the trade-offs, when you think about concentration,